I mean, this got to be the worst month ever for Meta stock here, underperforming 33% in 1 month. Same with PayPal, underperforming 34% in just 1 month after both of their earnings were released, the Q4 earnings for 2021. So now we have to think about, is this a buy the dip opportunity here? Is one worse than the other? Can we buy both even? So let's go through some of the key things to consider here by going through both of their Q4 earnings reports, but then also look at a valuation and look at it from that perspective to see, are they now historically trading cheaply, or is it just that they were at all-time highs recently and now they corrected to a more reasonable level? So all these sorts of things you have to consider before you buy into any kind of dip situation, right? Even if it's a company like PayPal or Meta. So let's get straight into it. So first off, we'll start with Meta, with Facebook, basically the group. I've got the Q4 earnings report here. It's their first time releasing the earning report under the new name Meta, for some people that might not know that. But yeah, let's head straight into some of the concerns that people have with their earnings report or with Meta in general. So one of the big concerns obviously is that we think that there's a slowing user growth over time now, as Facebook and all their platforms basically have reached, the market potential globally, so to speak. So we've got a chart here that is the family daily active people on the platform, which shows basically whoever is a registered and logged in user for Facebook, Instagram, Messenger, and WhatsApp. Basically, at least one of the family members visiting the websites or the platforms on one of their mobile devices. So we do have to have in mind, although we do see straight off the bat, we see, of course, there's a slowing growth here. It's not an exponential growth. We've kind of are very high, and now we've reached sort of, the max levels here. But we did start 2 years ago. We were already at 2.26 billion people using one of their platforms on a daily basis. That means it's just every third person in the world is using this, whilst some of them, probably 30-40%, don't even have internet. So if you think about it, it's pretty much almost everyone in the Western world is using one of their platforms on a daily basis. I mean, for myself, I know that I use WhatsApp and Messenger on a daily basis. Facebook, I might check once a day. But Instagram, I definitely check multiple times a day. So I'm one of them for sure. And if you think about it, even from 2.26 billion people, they have been able to increase that slowly but steadily over the past few quarters to now 2.82 billion people, which is still a massive growth. That's basically more than Snapchat's user base in those 2 years, just from the growth perspective. So one of the concerns here is that, people are not using Facebook anymore. It's a slowing growth, it's kind of a dying business as such. You have to just think about how much 2.8, almost 3 billion people are. And if you get so many eyeballs on your platforms, the companies or businesses, they just don't have any other option but to advertise on one of those or multiple platforms. And that's just the strength of Facebook. I mean, that's not going to change overnight, that this market dominance, their platforms, even with things like TikTok, all you do is taking time away from people to maybe spend on TikTok, but overall you're still a user of Facebook, Instagram, and so on. You still have a profile there, and you're still gonna regularly check it, because TikTok is just not the same. It's not the same platform. Like, I don't go to TikTok and share about my life or my pictures or something that I've done. TikTok is a entertainment platform in my point of view. So what's important here to note is not actually the user growth, what some people are focused on. I think what you have to think about now in terms of Facebook and Meta, they've already reached that high level of, crazy numbers of almost 3 billion people. So what's important is the actual revenue per person, because obviously, if you reach that capacity, there's no more or not much growth left, right, for the business. But what's left is to squeeze out more dollars from the existing huge platform. So basically, what Facebook can just do is increase their ad rates to generate more revenue of their existing database, because they already have 2 to 3 billion people going there on a daily basis, which just makes a massive market, makes a massive opportunity for advertisers to go on there and then advertise on there. So we did see that growth. We still see, if you take a line through this, I mean, obviously it's fluctuating on a quarterly basis, but we did see a massive all-time high number now for the last 2 years of $9.39 per person of revenue. So we do see that Facebook, especially in the last year, they've been able to increase that price of advertising, squeezing out more profit from every person. And then looking at the daily active users by geography, we do see still a nice growth here in the rest of the world and the Asia Pacific region. We do see that obviously US, Canada, Europe, those markets seem to be saturated. They don't really grow as much anymore. There's even sometimes a slight decline of active daily users. But we do still see the rest of the world growing, and also especially Asia Pacific is still growing. One of the challenges that Facebook does have is that we've seen sort of margin compression. So we've seen a lot of more expenses, cost of revenue, as they call it, that is related to that increased revenue. So that's something we have to look out for. As you can see that expenses as a percentage of revenue, they do tick generally up here. We do have some, they stay kind of consistent, fluctuate on a quarterly basis, but for the last quarter they did have a slight uptick here for the last 2 quarters. So we do have to look out for that, although we've seen that historically that's always been the case towards the end of the year. So obviously with more sort of inflationary pressures and more economic uncertainty and an ongoing pandemic, companies do might not spend as much marketing as they used to, so that Facebook has to market more and have more costs basically to acquire customers, to get customers to advertise on their platforms. So we did see that happening, which is something to keep in mind, as well as the effective tax rate now being quite high the last quarter for 19%. We haven't seen that number since almost 2 years. However, if you look at the net income, it's just really, really strong numbers. You just see that the business is basically maturing now, having a really high level of net income here, and that also luckily translates into a good free cash flow number, which is really important to see for a more maturing company like Meta, which ties into my next point. Because of that strong cash flow, they can obviously spend a lot more on R&D and capital expenditure, on basically the future of the business. They've just recently rebranded to Meta with the intention of them becoming a huge major player in the metaverse, which is gonna be undoubtedly a huge thing in the future, in the upcoming future. So if you have that long-term view of, okay, I believe in their vision over the long term, and I can kind of see beyond that, a weak quarter or two that is ahead of us because of some of the pressures, then you might get a really good buying opportunity here, given that they are heavily investing into the future of the company. They're not just collecting the cash and becoming like a value company, a value stock. They are trying to progress into the next stage, as they also recognize that their growth is slowing, and then basically that their platforms have reached sort of the potential. Now they can only increase the amount of advertising revenue, advertising dollars they get, but they're not really growing any user base anymore. So they did obviously realize that already a long time ago, and now they're venturing into things like Meta. They did the rebranding. So I'm excited to see what's going to happen here, right? What's going to happen here over the long term with Meta. And also one thing to mention here is obviously we had huge amount of negative news. I mean, usually Facebook itself is a highly polarizing stock because of, because of the scandals that we had in recent history with the data analytics, what type of data they're collecting from me. Like people love to, hate on it and talk about it, and it's hugely polarizing, and especially in the last two weeks as well, like after those earnings came out. So now, as everyone is saying, basically it's done, it's over. Facebook is done. I mean, if they're done and they're getting, if I have a business that's done and I get 10 billion of free cash flow, then okay, I'll take that business. But yeah, that might actually be a good thing for the stock, because over the long term, polarizing stocks such as Tesla, Palantir, I think those have always there is a reason why it's polarizing. If it was something that no one would care about, I would be more concerned. If everyone stops talking about Facebook, that's almost more concerning as if people still keep talking about Facebook, discussing their future and so on. And they usually do it ironically on Instagram, on Facebook and so forth, right? So that's something we have to think about as well. And then I've pulled up here the chart of Meta platforms just to take a look at the valuation, right? So because obviously we had this huge drop. So what I've done here is I've got a chart over the enterprise value to EBITDA, which is quite a good comparison for something like Facebook, to see how this has historically been trending and where are we now at the moment. So we're pretty much at, if you zoom all the way out, we are pretty much at levels that we haven't seen since the pandemic, or since that horrible, December month of 2018, where also sort of all the tech and growth stocks were hit hard. So we're at a pretty low level historically speaking. I would say the mean for this stock seems to be more in the 12 to 15 range. So to see it below 10 is, from a valuation perspective, quite good. And then going down here, we do have the comparison again to similar types of companies like MasterCard, Shopify, Fiserv, and Block. We do see that the EV revenue, the EV2 revenue, basically price to sales, is quite low when comparing to MasterCard or Shopify, which are sitting at a 16 and 18. It is more in line with something like a mature business like Fiserv and Fidelity, which you can think for yourself that you would want to value PayPal more at something like a Shopify and MasterCard in between, maybe, because they are mature, but they're still quite growing. Not as mature and not as slower growth company compared to Fiserv and Fidelity. So we do think that this seems to be quite low. EV to EBITDA is also the same thing. We do have a higher number for MasterCard and Shopify, but we do a lower number, but we do have a slightly higher number than Fiserv and Fidelity, which seems to be all right. PE also is kind of in line. Really depends on which one you're picking here to compare it with. That PayPal is at a reasonable PE, let's say for their 20% plus growth rate. Same when we go to the median numbers here, we do see that revenue is slightly above that, EV to EBITDA in line, I would say, and PE slightly above. So what does that mean? It basically means that PayPal has just corrected over the past few months from their historic highs over the past 2 years, which now they've come back to a more realistic, more reasonable level, maybe slightly below sort of the intrinsic value or historical valuation multiples, which are some sort of in line from 20 to 25. So now we're below that 20, giving us maybe an opportunity here to scale in slowly into the position to see what's happening over the next few months. So going over to the actual PayPal metrics here to see what's going on with in terms of the growth rate. So we do have active accounts growing, has been slowing down for the past few quarters, but if you take the average here, we're still above 20% year-on-year growth for active accounts. Same goes, or at least let's say over 10%. Same goes with over 20% growth for payment transactions. So we do grow much faster as something like a Meta. We're still in a growth mode, I will still call it. Although it's a mature company, we'll still call it a growth stocks growth company. So that actually, although it's been slowing down, we have healthy growth rates here. Something interesting to note here on the revenue side, so we did have that growth trajectory slowing down a little bit. We had the last few quarters only growing at 13%, so I think investors were hoping for a bit more of an uptick as we've seen in the last quarters of 2020. Nevertheless, we still have a growth from Q3 2020 of 5.5 billion to now 6.9 billion in Q4 2021. So the growth as such is still healthy, but there is a caveat, which is actually a positive thing, because that growth is including a decline of sales transactions from eBay. Because if you didn't know, obviously this is how PayPal became famous, to be the payment transaction solution for eBay purchases. So this is how PayPal really became, like the global company it is today. But then one day, a few years back, eBay decided to leave PayPal and pursue their own payment solution. So since then, they have been slowly removing, the transaction that go through PayPal. So every quarter that you see here is impacted by a decline of eBay transactions. So on the right side, we now see a cleaned up version, basically revenue year on year or quarter on quarter, excluding eBay transactions. So then you can see we do have a much more exponential looking like curve here, that we've grew revenue from 3 billion 2017 to 6.7 billion, over double up in 4 years time, excluding the eBay transactions. And I think what's going to happen Q3, Q4 this year, I think this is when they expect that all the eBay transactions will be removed completely, so that the growth for the total revenue will more look like this graph here, which obviously will be an interesting thing for investors, because even though everyone should know by reading the investors presentation that eBay is excluded, or eBay declines are included in the sales numbers, it's still something that might increase the investor sentiment if they see the graphs just looking nicer and the revenue growth looking cleaner on paper, if eBay is completely removed from the revenue numbers. Going back to the metrics overview, there is one thing I wanted to alert to you, and that is the increased or basically decreased transaction take rate. So this is something I've called out earlier as well in my first video about PayPal. So basically we're down here from 2.2% to only around 2.04%, and the transaction take rate down from Q3 2020 to 0.6% to now 1.88%. So although they keep growing their active accounts and their numbers of transactions, and also basically then therefore their revenue, they do have what seems to be pressure on their fees to be able to compete with all the other competitors, so that the take rate is reduced. So we have to obviously see that we have to monitor that going forward to see if PayPal has lost its competitive advantage here. It lost its mode basically. I mean, we do know that PayPal is not the only one anymore. It used to have a big moat, and it was the only secure internet payment solution. Now there's a lot of options available, but to my next point, if you will see that digital wallet acceptance across the world is still huge for PayPal. PayPal is way ahead of the competition. So if they can use their free cash flow wisely to reinvest into new products, new app, as they do, and also, you know, get into the next generation similar to Meta, then we do have a great opportunity still here, because they are producing massive free cash flow at the moment. They reached a similar stage to Meta actually, where they're still growing more than Meta, but they're producing really good free cash flow, giving them an opportunity to invest and reinvest into other things, right? But yeah, if you look at this graph, that's pretty impressive. PayPal is the most accepted digital wallet, so this is showing the percentage of the acceptance amongst the 1,500 largest online retailers across North America and Europe. So we do see that PayPal has massive advantage, like even compared to something like an Apple, Amazon, or Google Pay, which even together are not reaching PayPal's acceptance share, which is, I mean, impressive. Yeah, we do see new competitors coming in. Something like Affirm, ShopPay, Afterpay, they're relatively new and they do increase at a rapid pace, as we see here. But you know, PayPal has that free cash flow to actually be ahead of the competition, to get into new products, such as they do with their new super app, right? They're innovating and they're having all-in-one app here. And they also, you know, obviously have other cash cows like Venmo, which is another app complementary to PayPal. So all of that is helping them, and if they keep being ahead of the competition by reinvesting their cash flows, we're hoping that, you know, we have a good growth opportunity here for the long run. I mean, yeah, what happens next year, no one knows, but for the long run, I do see this growth story still intact. And then for this one, we're going over to the valuation now. I've pulled up a similar chart, so the EV to EBITDA for PayPal, just to see on a historical basis, where are we trading here? Because usually we did see PayPal trading pretty high during the COVID pandemic, 2020, 2021. So now if we look at it from a historical perspective, we do seem to be in line with that. I mean, you know, cautiously speaking, we are, I guess average would be around 20 to 25. Now we're below 20, so we're definitely trading at a discount. But last year we were pretty much trading at really high numbers. I mean, 2021, it's been consistently trading to up to 40. So yeah, basically trading pretty high, 45 even sometimes. So it was trading relatively high, so now it's been correcting down. I guess this would be the normal level here around that, but now recently on the Q4 earnings reports, it's dropped even further. So I guess since that last drop, we can say we are trading at a bit of a discount here to historical numbers. You can see it 18, and last year's it's just been crazy, like 37, 42. So don't look at those numbers, look at a bit further out to what you know, before COVID, maybe what PayPal has trading at. We do see a discount, but it's not a massive discount as it seems, because from the highs we're down like 50%, right? So keep that in mind. And if we go to the competitors here, we do see that PayPal from a EV to revenue trades at a bit of a discount to everyone else. More so to others than you know, many others. So like more so to Shopify, for instance, 18 compared to others like Block is trading actually even lower. EV to EBITDA, we do see some of them trading lower, but they're more like matured companies. So if we're looking at other related growth companies, we are pretty much pretty low on that at that stage, and also when it comes to the PE ratio. So, and then down here we have the median numbers, which I always used to like to look at. So EV is slightly above the median, EV to EBITDA is also above, and PE is still above. So we're not trading as cheaply as Facebook or Meta, but we have come down to quite a reasonable level here. I would say since the last drop last week, basically we've reached it's called a discount level. So PayPal before was trading a bit high, and we sort of reached a new good entry point, I would say, to maybe start and scale into a position at those levels. Yeah, so thanks for tuning in. I will buy the. So thanks for tuning in. I will buy both dips here actually this week. I'm planning to get into Meta and PayPal. I've been buying in the last few weeks a bit. Do leave me a like and subscription here if you like that content. Do leave me a comment as well to see are you buying the dip here or not. And do check out my other videos on my channel. But see you next time.